All right, welcome back to Asset Coach and Tax Strategist. My name is Robert Wolf. I'm the founder and CEO of Terra Firma Business and Financial Consultants. And if you're a subscriber, thanks so much for subscribing. If you have not subscribed yet, please feel free to hit that subscribe button. Leave us a thumbs up if you like the content that you're hearing. And if you have any questions or if there's any topics that you want to discuss or talk about, or you'd like me to discuss and talk about, put it in the comment section. I'd love to hear back from our subscribers, our listeners. It helps us create that content and provide content that's specific to you and what your needs are and what your concerns are. So today we're going to do a sequel on a couple other videos that we've already done before. So we've already done a video on income funnel. We've already done a video on the three stages of an asset. And what I wanted to do is kind of create the sequel, just kind of bring it all back together, bring it together, show a couple examples using the income funnel of what this means and understanding your numbers, understanding the type of assets you're in. And that's the key here is that I'm going to use a couple examples of assets. I am going to share my screen. I have a quick little PowerPoint to kind of go through some visuals to help with this dialogue and conversation. But again, this is for you and to give you some examples and ideas of what this looks like. At Terra Firma, when we bring on clients, they become members, and we have this process that we take everybody through, which is a cash flow recovery. And it's the initial 15, 20-minute conversation just to let you know, can we help you? Is your situation something that we're able to assist in? And then if so, go through that process of becoming a member. We have a discovery process where we go through and kind of build out these plans for members of showing them, here's what your current situation looks like, and here's what we can do based on all the information that you shared with us. What I'm going to share with you today with the income funnel as well as the three stages of assets are visuals that we take people through in this conversation. And we have this content in our courses. I talk about this stuff in both of my books, Economic Termites, as well as Farming Assets. So this isn't new. But I find the benefit of repetition, it helps to retain information. This is my world, not your world. And so different ways to communicate it to different people at different times is helpful because we all have experiences that we go through that determine if this is information that's beneficial to me or not. So I'm going to go ahead and share my screen. And let's just kind of dive right in here. So we're going to start with the stages of an asset, and every stage goes through every asset goes through three stages. And then what I'm going to do is I'm going to go through this process for you. And as I go through this process for you, I'm going to transition into what I call the 5Ds. Now, if you've seen any old videos, or I always talked about the 3Ds. Well, we added 2 additional Ds to this process. And just because we're getting better at what we're doing more research, we're diving more into learning more into what we do and perfect our craft and our skill for you and for your benefit. And so as we do so, we add that information and that content to what we're doing for our members. All right. So I love this quote by Warren Buffett. Someone is sitting in the shade today because someone a long time ago planted a tree. And so that's what we're trying to do with this YouTube channel, with our membership. We're trying to plant a tree. So one day you can sit in the shade. Sometimes it takes longer than others, and sometimes it's instant gratification depending on your situation. So as we go through this, really we call this our asset buddy system. An asset buddy system is really designed to say, okay, if I have an asset and every asset goes through 3 stages, how do I get all my assets working with each other in unison? So one of the things I talk about is the assets need to be organized. Okay. So people come to us because they want tax savings. But the reality of tax savings, that's a result. The taxes are a byproduct or a result of what we have done in building assets. So for example, as a W-2 employee, you're an asset, you generate income. Oh, okay. So taxes are a byproduct of the income earned. So that's what the government taxes. Now, what kind of income depends on the type of asset. Okay. And so the asset buddy system utilizes what the wealthy use and multiple different types of assets and entities and industries to create this end byproduct of lower taxation. But it all starts at the beginning of you and what assets you're going to have. And so understanding what the 3 stages that assets go through is very important. So obviously, the first stage is contribution. You're going to make that initial investment into that asset. Okay. So let me use a 401k plan as an example. Okay. A retirement plan. Most people understand that it tends to be more common. May not know all the details and ins and outs, but you know that when you make a contribution, it's a tax deductible contribution, meaning that it's going to lower your income that's taxable. Okay. And that's your personal contribution. Now, when you do that, it's tax free. Now, if you have a pension plan or a profit sharing plan, the company makes that contribution to or on behalf of you. Okay. So on your behalf. Well, it's a deduction to the business. Okay, so that's the first stage, contribution. How's the IRS going to tax it? Well, here in a 401k plan, as an example, it's a deductible expense. Okay. Now, once you make that contribution, that investment into that asset automatically goes into the accumulation stage where it grows. That's the whole point of an asset, is to accumulate and grow. Now, with a retirement plan, it's tax deferred, meaning all that growth and what could be taxable does not get taxed. It gets deferred. So you're compounding your growth. Okay, to where it all goes to the last stage of this asset, which is distribution or income. Okay, so a retirement plan is designed to replace your income. Therefore, the distribution or the income taken out of the asset is ordinary income tax. By the way, 401k or retirement plans are really the only investment that we have access to grow and compound, and we're taxed as ordinary income. All the other assets are taxed at capital gains. Okay. Why? Because this is designed to replace income. So let's look at it from the government's perspective. They need tax revenue. And so that's what they created. They created a retirement plan, encouraged you and I to put money for our future to quote unquote retire. And then when we start taking money out, they tax us not at capital gains rates, they tax us at ordinary income. Now they justify it because you had a deduction, ordinary income deduction in the beginning. You didn't pay taxes on that. And then it accumulated. You pay no capital gains on that growth as it accumulated to where now you're paying taxes. All right. So that's that. Now let's talk about your business. If you're a business owner, right? So your contribution or your investment is what we consider cost basis. It's principal. Okay. So that's money you have that probably is already after tax if it was savings, or maybe you borrowed that money. When you borrow that money from a bank, it's not a taxable event. Okay. So your contribution or investment into a business actually is considered tax free. It creates your cost basis, it creates your value initially. Okay. And now, the moment you start putting that money into your business, it starts accumulating. Right now, your business has two values versus a 401k or retirement plan has one value, a value of what it's accumulating to create ordinary income or income at the end. That's the third stage, right? The distribution. Now, a business creates two values. Your accumulation and growth, your business gets to appreciate as your business grows and your revenue grows and it becomes more and more mature and successful. There's an appreciation of that, meaning that down the road, you can sell it to somebody else and make more money than what you put into it, right? So that would be taxed at capital gains on the third stage, right? But at the accumulation, you don't pay taxes on the appreciation. What you do is pay taxes on the profit. Okay. So what happens in this accumulation stage is that within that year, you have your revenue, you have your expenses, and whatever's left over is profit. And then that will be taxed as profit. Okay. So it'll go to your page one of your 1040 and you'll pay income taxes, ordinary income taxes on that number. Okay. So those are two examples. We can do real estate. We can do pretty much every asset, and they all go through this. And the IRS and the government views them differently based on how they're going to tax them. Okay. That's important to understand because as we start going through what we call the 5Ds, we need to understand the 5Ds are the most efficiencies of an asset. Okay. So three of them are from a tax perspective. How do they grow most efficient based on the tax benefits the IRS or the government provides? Okay. So let's talk about that. So as we create this asset efficiency, meaning that it can accumulate, we can reduce tax liability because of what the IRS provides benefit to. You create this asset efficiency within this asset buddy system. So this asset buddy system means that we have multiple assets that are all working in unison, just kind of like a car engine, right? A car engine, you have multiple parts. They all have different things that they're trying to do and accomplish. And you put gas and oil into it. You put gas into it, and it starts the engine. And you have oil to simplify the movement of each of the parts, right? And it creates this energy, and you get to go. Okay, so your assets work the same way when they work with each other. Most people come to us with just one or two, maybe three assets, but they don't have a plan in place. They don't have a system in place to get all these assets working together. When you do that, you create asset efficiency. And when your entire asset buddy system is working efficiently as asset efficiencies, then you create this velocity of money. Robert Kiyosaki talks us about this velocity of money, where money just compounds, and it's kind of like a runaway train at that point, right? Well, our goal, and anybody's goal, should be your asset buddy system, or your system for your portfolio of assets should be generating enough appreciation and enough of growth to outperform your personal ability to earn. So if you're a W-2 earner, you make 600,000 a year, you want your assets to create a greater value of 600,000 or more than you. Once your assets have created that, you've hit this, what we call velocity of money point. Okay. That's ideal. Okay. That starts that conversation of freedom. I'm practicing medicine because I want to. I'm a mechanic because I want to, not because I have to earn money to pay bills, put food on the table. Okay. The desire to do something because you want to versus you have to means that we get to perform at our own ultimate peak and our ultimate performance. Okay. And it no longer becomes a job, it becomes a lifestyle. And you never work a day in your life when you enjoy doing something in your life. And so it's not considered work. Okay. So let's talk about these 5 Ds. What are they? Well, the first D is business. A business provides the first D, deductions, the most efficient asset that gives us the most deductions. Okay. Now, the government could tax top line revenue. They don't have to give us deductions. Okay. As business owners, they give us deductions, credits, incentives, and rebates. And they give us these tax benefits. So our revenue, we take all these benefits away and we have more cash flow. And they know if we have more cash flow, we're going to take this money, put it back in our business, and accumulate and grow our business. And we end up hiring W-2 employees. So when we look at the stages of an asset, a W-2 employee is paying ordinary income tax. We as a business are paying payroll taxes. This is the revenue. This is the ATM machine of the IRS or the government, is payroll, W-2. Okay. The more people you hire, the more successful you are as a taxpayer, really. There's nothing saying as a business owner you're required to pay taxes. You're required to pay taxes on your taxable income. But if you're utilizing an asset buddy system to where it's working efficiently and your taxable income drops, but you hire 20 people, the payroll taxes and the taxes that they're paying outweighs what your individual tax rate is. So the government, the IRS, is our business partner by giving us those tax incentives, okay? And to create that tax revenue. Most people don't understand that. Most politicians don't understand that. The next D is distribution. It's that whole part about income, right? What creates the most tax efficient income is cash value life insurance. There's really 3 assets that create tax-free income. You have your Roth IRA. There's lots of limitations to that. We create backdoor Roths, right? We create all these strategies to try to create this Roth environment, but there's limitations to that. The government gave it, therefore they could take it away. Right. The other one is municipal bonds. Well, municipal bonds, you have to have a lot of money to get a return. The interest is usually lower than corporate or traditional bonds because of the tax-free nature of it. But also, when there's a downturn in the economy, and we learned this in 2008, what happens to a lot of these cities that are over leveraged and overextend themselves? They file for bankruptcy. And what happens to your municipal bond, right? And so there's still a risk and an issue, and you typically you have to have a lot of money in that to create a lot of tax-free income. So really, cash value life insurance is the value or the vehicle that creates this tax-free income for you. And as your value grows, your wealth grows, because of your asset buddy system, your life insurance value increases. So you can actually increase this and your limitations become less limited. Okay. And if you're a business owner, you have two values. You have your personal value of what you are to your family, but then you have your business value and what that looks like to your business. So you actually have double the value. The government wants you to do this. Why? Because anytime they give you tax benefits, the greatest tax benefits for a particular asset, they're telling you we want you to do it. Okay. But what are the two things that we've talked about? Business and cash value life insurance, and what most people don't want to do. Most people don't want to get into business. Oh, it's too hard, right? Or, oh, it seems like it's so risky. Right. So that's, there's some of the conversations or comments that we hear. And then cash value, oh, it's life insurance. Or you have certain people saying, oh, you're just trying to earn a commission, or it's not a very good investment. It's a asset, not an investment. It's an asset. And it's how you use and design and the purpose of your asset that makes it valuable. Real estate, oh, it's a great investment. But what if it's not? What if it doesn't create the income you want? What if you have constant issues with your renters? What if it's the building's falling apart? Is it really a good investment then? It's an asset. All assets are only as good as how you maintain it and the use of that asset. Okay. But tax-free income from this distribution, that's awesome. That's awesome. And so when you have real estate, that allows us the third D, depreciation. Now, we know this is a great benefit because the IRS tells us so. When you go to your Schedule E on the 1040, the Schedule E, you'll look at revenues, rents, royalties, and then you have a list of expenses. And all these expenses, and the last expense line, it says depreciation. But not only does it say depreciation, it's in the expense line. It says depreciation expense. It's the only expense in that expense line that says expense at the end of it when it's in that expense list. Why does the government do that? They're telling you, they're giving you a clue, like a video game. They're giving you a clue. I am giving you a gift. There's a benefit here. Now, this depreciation can be accelerated utilizing cost segregation rules and utilizing certain things. But the problem with that is that if you accelerate your depreciation, you lose that depreciation in future years. So you actually create more income. So the government's so smart that they understand that that's what people have to do. So then what they have to do, they have to take their investment and buy more real estate and keep depreciating it and keep kicking that down the road. But we have a lot of real estate investors, a lot of people who come to us that own real estate that have a tax problem. Why? Because their asset isn't being managed with a buddy system, with an entire portfolio and system of other assets. It's a mono portfolio, meaning it's only focusing on one particular asset, real estate. Or you have people with just a business and they have a tax problem. They just have a business, right? So you have to have this system and these assets that work with each other to create that tax benefit as an outcome. All right, debt is the fourth D. Oh no, you listen to Dave Ramsey and Susie Orman and a lot of these talking heads like debt's horrible. Personal debt, yes. If it's not managed correctly, it could be really bad. But when it's debt in a asset, the government actually gives you a lot of benefits. And to bring on debt, it's a tax benefit. It's not a taxable event, so you can borrow money, not a taxable event, and that money gets put where? Into an asset that creates what? Appreciation, capital gains, or cash flow that is potentially taxable, right? So it leverages the other assets to become more productive, velocity of money. So used correctly. And within the business world, when you use debt to help leverage growth, the banks want to give you more money. Why? Because then they're going to make more money. Duh. The IRS wants you to have this because they want your business to grow. They want you to build assets because it benefits them. They'll know they'll get tax revenue. Okay? Everything is about the flow of cash and how you use that flow of cash to create taxation. And if you don't know how these stages of assets work and how the IRS views each asset, you will unfortunately be overpaying in taxes. that you don't have to. But you just got to follow what the government tells you, the IRS tells you. So many people want to be adversaries and the IRS, we hate them. No, they're a great business partner. They tell you exactly what to do. We want to look at it and say what we think they're telling us we can't do things. No, they're telling you exactly what to do. Just like any rules in any game. Here are the rules. Follow the rules, you win. Plain and simple. You make up rules, you lose, right? It's no different than with the tax code. And the last D, the fifth D, is decentralization in crypto. Okay. And this is a huge topic, which we won't go into in this video. There's so much to talk about. I mean, it's like real estate. Each of these Ds, we can have an entire separate series discussing, and maybe we'll do that in the future, depending on some of your comments and feedback we get, of diving into each of these assets and how these assets can work and perform, and how there's different ways to use these assets, different purposes and different structures, and just it's just such a huge big world. So this is really important to understand and know. Okay. So these are the baseline of when we get into the income funnel now, understanding the income funnel. And the income funnel is really also part of what we call tax bracket management. And the reason being is that when we get to a couple slides from now, I'm going to show you how the progressive tax system works. And that's tax bracket management. We'll talk about that. So I have two examples. Here's our income funnel. And so I'm going to get my little writing tool. And so we break it down based on wages, and your wages come down the funnel and they summarize on your personal tax return. You have your K1 or your business profit. You have your real estate cash flow, and then any investments, whether it's interest, dividends, or capital gains, flows down this income funnel, and it all summarizes on your personal tax return and creates taxable income. So here's an actual member of ours this is their taxable income, right? This is how it's broken down. And this is what we do with our members. We break it down so they can visually see. Okay. And so when we go through this and we look at the actual income funnel based on a progressive tax system, what happens is a progressive tax system says 0 to 22,000, your first 0 to 22,000 of income is taxed at 10%. Your next 22,000 to 89,450 is taxed at 12, so on and so forth. This is called the progressive tax system. So when people say the wealthy need to pay more, they are. They are. What you don't understand is the wealthy understand the asset buddy system. They understand that there's other assets to help bring their income lower. And when we go back to the income funnel, they bring these other assets to help these assets using the tax code to lower the amount of income that goes through the income funnel. Okay. So you just follow the rules, know what those rules are, and so this is what it looks like. So we have a particular client that's in a marginal rate. So these are called marginal taxes. So 24% marginal rate, and due to some planning and helping them to shift some of their some of their existing assets, help them to build new assets, we're able to, with all this, the tax code says, hey, your taxable income can be lowered to about $76,000. Okay. And so that's what we've done. We've established a game plan to do that. Now, when we look at this and we break this down, is, within the 24% tax bracket, what we've been able to do is free up 136,000 of cash flow, not going down the income funnel, but instead going into cash flow into other assets, whatever those assets are, and they'll appreciate and grow and create taxes down the road. But today, short term, it ends up creating a $32,000 tax savings, and then there's 101,000 here, and we created 22,000, and there's 54,000 here, and we created 65. So we were able to shift 292,000 into other assets to appreciate and grow, and which yielded end up being about a $61,000 tax savings. Okay. But where did that money go? We just didn't wave a wand. We're actually putting money into productive use into other assets. That's what the government wants you to do, because when you take assets to create other assets, they create those 3 stages of asset and create tax revenue for the government. They want you to do this. This is exactly what they tell you to do. That's why they give you tax benefits of doing it. Okay. You're actually generating more tax revenue for the government than if you didn't. And that's why they have little tax benefits for just W-2 employees because you're not going to do stuff with this. And so they minimize or limit the ability of use of the tax code. And so they tax you the max that they possibly can, get whatever they can out of you. Okay. Okay, so here's another example. This is another business owner who takes W-2 wages. He has enough business profit that flows down. So both of these flow down the income funnel. They have real estate, and that flows down the income funnel. And then they don't have a lot of liquid assets, meaning stocks, bonds, mutual funds, interest, dividends that are passing through. And so all of this passes through into the personal tax return. Okay, and so they have a taxable income of 2.1 million. So when we look at this from an income funnel perspective, their marginal rate is 37%. Okay. Now, when we do our planning and we actually show them how to shift the majority of these funds into other assets, like what they've done, but structuring it the right way, structuring it the way the government has said to structure it to create more tax revenue for the government because it creates more growth and wealth for you. The government knows it'll create more for them. Okay. Again, which is why they give you such great tax benefits. Okay. So now they're in a marginal rate of 35%. Most people go, well, that's still a lot, but it's not compared to where they were, right? So there was about $1.5 million that we were able to help them shift into other assets, which created a $500,000 tax reduction. And then about 16,000 in the 35%. So there was about 1.5 million that we shifted out. It created about 560,000 tax savings. Which that tax savings, where's all that 500,000 going? It's going into other assets. It's appreciating, it's growing, it's building more and more wealth for that particular client, but also for the government because these assets house people who have jobs and pay taxes. They create more employees for their own business, so it creates tax revenue and payroll taxes from that perspective. And you can just keep going, starting new business or investing in new businesses to create innovation and to that's the way the tax system works. And so the three stages of an asset, it's so important to understand those three stages of an asset and how each asset follows those stages, how the government and the IRS taxes those stages, and how to use those assets in those stages to be able to generate more and more wealth and utilizing that tax reduction and tax savings based on how the IRS tells you to do it into growing more assets. Okay. And that is, I mean, it sounds simpler than what it is, right? There's a lot of work that has to be done here because you got to follow exactly the rules and the guidelines of what the IRS tells you to do and how to do it and how to structure it and why to do it and what the purpose is and all this fun stuff. There's a lot to be done. It's not just easy waving a wand. That's why the government gives you such great tax benefits on it because it isn't easy. And if you go through this process, because it's not easy, you get a reward like a video game. You keep going through the different levels. You can't get to the next level until you finish the current level, and so on and so forth. And the more you do, the more you're powered up, the more advanced your character is. The harder the levels get, but you become more advanced. So the levels actually become easier because you're more advanced. Welcome to life. Video games are based on how to build wealth and reduce taxes. As crazy as that sounds, that's the reality of it. So anyways, hope you like this content. Give us a thumbs up, subscribe, add some comments below. That would be helpful. And again, once again, my name is Robert Wolf. I'm an asset coach and tax strategist. I'm founder and CEO of Terra Firma Business and Financial Consultants. Thanks so much for investing your time to learn and gain more knowledge so you become more productive in your family and your community.